This is the Savvy Investor Podcast. What's happening, Savvy Investors? And I'd like to welcome you to another episode of the Savvy Investor Podcast, where we discuss all things real estate investing, provide you invaluable market insights and expert advice to help support you to live the savvy life. So I'm your host, Mike Ponte, founder of Savvy Investor and longtime Canadian real estate investor. And today we got yet another treat. I swear, every episode is a treat, which is always good, right? Hopefully the topic's good. But we get a chance to go behind the curtain a little bit with one of Canada's largest real estate investing companies, Equiton. So today's episode, we had a great discussion with Kyle Agro, who is the Associate Vice President of Private Capital Markets with the company, to join us to, again, peek behind the curtain to learn a little bit about how they assess deals, key aspects that they're looking in for, and why they're still active investing in Toronto and Ontario. Again, this is one of those markets that are struggling, supposedly. But in this episode, again, we get to learn more about Equiton's investment strategy. Number two, how they deal with kind of a low cap situation, low cap rate market, and rent control in Ontario. That's nasty little thing that's happening in Ontario with those rent controls, and how are they kind of managing through this, and how they look at the strategy, and what are some of the key objectives that they have that has helped them with the acquisition process. So it is an excellent episode where we as investors can learn from their experience, their knowledge of a larger investment firm on how they invest in apartment buildings and how they've shared some amazing nuggets for us that are focused and interested in the multifamily space. So there's a ton of wisdom shared in this discussion. So make sure you listen to the absolute very end. So before we begin, we'd like to highlight this episode's sponsor. Today's episode is brought to you by our Savvy Investor trusted partner, Bar LLP. Are you looking for quality and knowledgeable real estate lawyers to be part of your investing team? Then consider Graham Barr and Brendan Hans from the Bar LLP team. They're a full-service law firm based in Edmonton, but servicing real estate investors all throughout Western Canada for all their legal needs. They have extensive experience in all things real estate, be it residential or commercial transaction, private financing contracts, corporate or joint venture structures, and due diligence analysis. If you need legal real estate support, trust Bar LLP to support your legal needs. I do, as they are my lawyers for all my real estate investing projects. To learn more about Bar LLP, visit their website with the link provided in the show notes below. Welcome, everybody, to yet another Savvy Investor Podcast episode. And we're in for a little bit of a treat. I got the big guns kind of coming out, the big guns. Mr. Kyle Agro joining us from Equiton. And if you guys don't know who Equiton is, you guys got to pay attention. It's a wealth of knowledge, number one, but they're doing some pretty big things, like really, really big things. They've got roughly 1.04 billion, billion with the B, under management when it comes to the multifamily space. Roughly 12,700 investors. And so now we get a chance to kind of peek behind the curtain with this amazing company. Kyle, thanks for doing this. This is going to be, I've been looking so forward to bringing you on to kind of share a little bit about the Equiton story and what you guys are up to. So
yeah, Michael, always happy to come on these with you. I'm really excited for the conversation that we're going to have today. I mean, a lot of things are happening in the market. We're up to a lot of different things. So peeling back the onion a little bit and seeing some of the layers that are involved with companies who are as in depth into this as we are will do nothing but help educate some people out there with getting into the weeds of it rather than just some of the clickbait stuff we see from the media at this point.
Yeah, I agree. Totally. Thank you. And thank you for being open and vulnerable with this too. So, for those that don't necessarily know who Equiton is, maybe you can just give us top level first of all, who you are, what Equiton is, and what's your involvement with the company.
Of course, my name's Kyle Agro. I'm one of the associate vice presidents here at Equiton. We're all-encompassing real estate investment firm is the way I would say it. The reason why I say that is because a lot of companies in this space kind of focus on one specific niche. We pride ourselves on having an investment for every different type of Canadian to be able to get started in real estate without a lot of the major hurdles that you're seeing, especially today in the type of, let's call it, macroeconomic environment that we're seeing. we have some options as low as $5,000 that people could get invested into real estate. And as you mentioned, we manage a little bit over of $1 billion in assets under management. We also have another $1.4 billion worth of development projects that we're working on at this point, moving into the future. So essentially, we allow Canadians to invest in real estate without coming up with large down payments, without having to secure mortgages in today's higher interest rate environment, and as low as $5,000, like I had just mentioned.
That's awesome. Like, I think, there's always a need. There's lots of investors, obviously, in our community, Kyle, and you know this, that they're active investors. They're out there buying multifamily properties, single family properties. I'm not sure if they'd be direct competition, but there's a lot of people that are not wanting to do a lot of this stuff. And this is really a great service that you guys are able to provide is, hey, you kind of get the best of both worlds where you know that you're getting the security, you got somebody else managing that, the toilets and the laminate flooring. You get somebody else is kind of managing that on your behalf, but you also kind of get the benefit. And that's the one thing I've always really appreciated about kind of Equiton's strategy and giving that option for people that are wanting to be a lot more passive in the space of real estate investing.
Yeah, just adding on to that, I mean, a lot of people think that they want to be active real estate investors, but then when they actually get into the weeds, passive makes a little bit more sense. But above and beyond that as well, active real estate investors really have an appreciation for what it takes to be successful as a real estate investor, and they tend to like this type of an investment model better than, let's call it, some of those public investments like stocks, mutual funds, ETFs, things of that nature. So what we do, we can actually take monies through people's registered accounts. So TFSAs, RSPs, LIRAs, RESPs, any of those government mandated programs. And people who are active real estate investors can get some of the good exposure that and in an asset class that they know really well and that they like within their registered accounts, which isn't something that's available if you're running an active portfolio. You can't buy a house through your TFSA, right? So
Yeah. Yeah. And I think that other part is, the amount of experience that you guys have had to go through, the knowledge just, and you guys got a huge team where for a lot of people there, this is something that they've had to build, myself included. And for even myself, I've got partners as well. And, I don't look at, Kyle as a competitor by any means. They're much bigger than I am. They're not even looking at me, but at the same time, they say the same thing. I got partners that are just like, I don't want to do any of that stuff. I wanted to invest with you first, Mike, just because I wanted to learn. But after learning what you do, oh my God, I don't want to do any of that stuff. That just sounds like a nightmare. I just want to make a good return on your investment. And you guys are taking it to just like the absolute next level. And this is one of the questions. How does a company like Equiton kind of get to like $1 billion in assets? And it's not even a very long time. It's that scalability is unbelievable for anybody that's listening. Think about that. $1 billion. How did you guys do this? Maybe share a little history if you don't mind about the company.
yeah, of course, let's go right to the beginning there. Equiton was opened in 2015 by our CEO. His name is Jason Roque. And I really see him as a pioneer and a visionary in the space. He did have a lot of experience in real estate before opening Equiton. He worked for a full-scale land development company. Right out of school, got a job at this land development company, ended up working his way up through the trenches of the company, nothing handed to him. And he ended up becoming president and CEO of that company. Now, it really just goes to attest, Jason is probably one of those, he's the hardest working person I've ever met in my life. He's one of those people who you could really feel good about getting behind when you're joining a company. And he's one of those people that would never ask you to do anything that he wouldn't do or hasn't done himself. So again, he's a visionary in the industry. Now, when becoming president and CEO of this development company that he worked for, he wanted to push the companies to new heights. And he had maybe a little bit different of a vision than what the company itself actually had for itself. And he wanted his own baby and to push things again a little bit further than what they wanted to do. So again, back in 2014-15, they ended up giving him a payout to when he was exiting the company, and he used his own money to start Equiton. Wow. So he was able to get a really, really good partner in the space as well. He knows the development side, he knows the acquisition side, he knows the due diligence side, and who he was able to get on his team to start Her name's Helen Hurlbut. She is our number 2 in command here. She's our CFO. She's a managerial accountant by trade, and she does all of the financial engineering, let's call it, behind everything that we do here, her and her team. But when they started, it was just the 2 of them. So it was 2 individuals starting the company back in 2015. She had previously worked for some really big names in the industry, actually. One of the more known ones, she was a senior vice president for Mattamy Homes. Most people know who Mattamy is. If you don't, they're probably the biggest home builder in the whole country, if not the continent. I know they're getting bigger in the US as well, but she was one of those very integral parts of that team and helped build them into what they are today. So the 2 of them took a whim, took a chance, kind of jumped out, started doing their own thing, put all of their own money into it themselves. But really what makes us so successful and why that makes my job a lot easier at this point in the game is really just the multi-stage due diligence process and the financial forecasting that you're doing. You really need to make sure that you're buying assets at the right price. You really need to make sure that you're looking overturning every single stone that's going to come up in terms of capital expenditures, in terms of what the cash flow could look like, in terms of what's happening in the market around it, the demographics, what government programs that say are going on in the area. Maybe that's not the best way of saying it, but other developments that are happening. So are there commercial going up? Are there parks, et cetera, et cetera? And just really making sure that you know what you're doing, because if you take a long-term approach and you do things properly and conservatively, then that's typically when things are going to work out your way. And again, turning, let's call it $20 million in assets under management from the humble beginnings all the way into what completed value with developments, putting that with assets under management of almost $2.5 billion at this point in 9 years, just really goes to show that they are true professionals, true visionaries in the industry, and we wouldn't be where we are today without those 2 in power.
Amazing. Very, very cool. So, for a lot of people who are listening to what you're saying, Kyle, I maybe can highlight a little bit about your guys' investment strategy. You're mostly focused in the multifamily space, if I'm correct, and in Ontario, and that's what you're talking about is, you already shared some really good nuggets for those in, our savvy investor community right now is buying well, buying right, and especially in this flipping climate, like it's crazy right now. Share a little bit about what types of assets are you guys focusing on? What's your kind of investment strategy? Because I think that's going to resonate with a lot of investors that are in the space right now.
Of course. I mean, we have 3 different funds here, so this is going to be a fairly long-winded answer because I'm going to go through each different fund and their own strategy. Okay. So let's start with the apartment fund. So our apartment fund is just as it sounds, it's just a bunch of large-scale apartment buildings that people can invest into. Now, all 3 of our investments have the same structure. So why don't we go through that really quick just so people can understand what
please.
we're doing and the way it works. Essentially, for each different fund, we opened up a separate mutual fund trust. Okay. Now, the reason why we opened it up as a mutual fund trust is because that's the structure that allows us to take registered monies. So that's the only reason why we can take RSPs, TFSAs, all of that stuff. Not to mention, it also allows us to work with people who are not necessarily an accredited investor. Now, we are highly regulated through the Ontario Securities Commission, so we do KYCs, know your client profiles, to understand people's financials picture as a whole and determine suitability based off that regulation through the OSC. But it gives us a little bit more wiggle room than if we weren't structured that way. Okay. Now, what we do is we sell units of a trust. So units of a trust, you could kind of think of them as shares of a company, but it's a little bit different because we're a private, not a public company. Being private means we're not listed on a public stock exchange. Okay. Units of a trust are giving individual investors ownership into that portfolio of assets. And we have a few different mutual fund trusts because we buy and operate different types of assets within each different trust based off what people are looking for, based on their risk profiles, et cetera. How Equiton comes into the picture is we are asset managers. So we are the ones doing everything in terms of managing these portfolios on behalf of our investors. But technically, our investors actually own the assets themselves through proxies of units of trust. Your name isn't on title, which you wouldn't want it to be from a liability perspective anyway.
Sure.
But you have a direct ownership in these assets, and you structure these investments like you own it yourself. So again, it's a way that you can get all of those returns and the same structure of owning it yourself, but without any of the undue risk that comes with actually owning it yourself. Now, with our apartment fund specifically, that's just large scale apartment buildings. Currently, we own 34 different buildings that are worth roughly $1 billion, and we manage about 2,800 individual doors. Okay. Now, I like to think of this as a direct alternative to owning your own rental property. And the reason why is we structure it the same. If you think about owning your own rental property, you have a renter paying you rent every month, plus you have a physical building that's going up in value. When you sell it, that's when you get that portion of your return. Well, we do it the exact same, except you get a piece of the 2,800 different renters paying rent. So you get a small portion of that in the form of what's called a monthly distribution. So on the 15th of the month, we pay this distribution like clockwork, like a paycheck. Okay, so you could quite literally take your cash flow on the 15th of every single month. Or if you're in a position where you don't need the cash flow, or you're doing like an RRSP where it doesn't make sense because now it's counterintuitive to what an RRSP is used for tax deferral, you can do what's called our DRIP program, which stands for Direct Reinvestment Plan. Okay, that's rather than receiving actual money in your bank account every single month, you would give it back to Equiton, and we would just give you more and more units of the trust. Now you're compounding in two different ways because you're getting more and more units of the trust. Plus, as we're getting appraisals done on our buildings, which we own the 34 different buildings, we get is what's called a hard appraisal. So an actual appraisal done, and we use the CBRE, probably the most highly recognized appraisal company in the whole country. They do a hard appraisal once per year on the anniversary date of when we bought these buildings. Okay. Now, obviously, we didn't buy them all on one day, so that's spread out throughout the course of the year. So the units of the trust that you buy, they go up as those buildings are going up in value. Now, the strategy behind it, I wanted to explain that first before we went into the strategy as you had asked for this. We have three different strategies within the fund, but the main focus is, and how we provide the most value to our investors, is through buying properties that are underperforming or undervalued, existing multifamily. Multifamily is defined as 5 or more units within one structure of a building. We're doing this on an institutional level. Just so you know, the biggest asset that we have in the portfolio is 360 individual units. So
wow, that's crazy. Wow.
In terms of how big that building is. Now, when we're buying these type of properties, there's a lot of due diligence and a lot of financial forecasting that goes into this. We are doing all of this on behalf of our investors, and we run 10-year financial performance. We have a buy and hold strategy that these assets are going to be within the portfolio for a minimum of 10 years. And the reason why is because when you buy a property, you're not just going to kick every single person out. Plus, you couldn't do that even if you wanted to, and renovate everything and then get a whole new tenant profile in there, right? So we're buying buildings that the old owners maybe didn't want to spend the money to put into it. Maybe they were happy with the status quo. Plus, when you're buying off non-institutional investors, which if you're buying buildings that were owned since the 60s, 70s, 80s, it wasn't the same climate as it is today. So a lot of family offices, let's call it, own these buildings. They're just looking to cash out at this point, right? Whereas what we're looking for, and we're doing all of the market surveying, one of the biggest things we look for is the gap to market. So how much they're charging for rent compared to what everybody else around them is doing and what we think these units could actually do. That's one of the things that we're looking for, because in Ontario, there is the rent control. It gives us a little bit of an opportunity because it creates a little bit of a gap there in terms of what people are charging now compared to what they actually could, where we're seeing upwards of 40 to 60% being left on the table.
Wow. Crazy.
Yeah. And when you're looking at multifamily assets specifically, how they're valued when you go to an appraisal is the NOI, so the net operating income. So if you could raise rents over time, plus decrease the expenses, then you're going to almost force appreciation in an upward trajectory above and beyond what regular real estate increases are happening. Now, we are not in the business of rent evicting people at all. That's not what we're looking to do. We're actually looking to create better communities for people to live in.
Yeah.
Okay. Now, that's one of the reasons why we have a buy and hold strategy, though, of 10 years, because we notice there's regular turnover within the portfolio of roughly somewhere between 14 and 17% per year. So that's people moving out, and then we can get new people in. Now, when we first buy a building, you can do the easy stuff. So the lipstick, making it look good on the outside, doing the landscaping, upgrading the amenities, putting a laundry room in, whatever it may be that will command people to look at it more and come in. And then as people are moving out, it gives you the opportunity to renovate the units, get new people in, and essentially get market rent for whatever it is based off of a brand new unit that's going in there. So if you have 40 to 60% gap to market and you're doing that over the course of 6 to 8 years to maximize the building, that is a way that we can make sure that our investors are getting the returns that they're looking for year in and year out through this type of a structure. As an example, the last building that we bought back in, I think it was November of last year, don't quote me on that, somewhere around near the end of the year, was a sister building of one of the buildings we already own, which is fantastic from a property management standpoint. Just makes too much sense because you save costs from property management. This building, as I was just alluding to what we're looking for, had a 60% gap to market. So that's something that we'll be able to take advantage of over years to come to give our investors those returns they're looking for. And the final thing is a lot of people ask me right now about interest rates, because interest rates are
hot topic.
Steady, let's call it.
Yeah.
So we're getting a little bit more creative on that side. And that's one of the advantages of working with somebody like an Equiton too, is we can sometimes see things that other people might not necessarily take into consideration.
Yeah.
And
true.
on this building specifically, we assumed the mortgage rather than getting a new one. Typically, what we're doing when we're buying is doing 10-year fixed mortgages, because that gives us a fixed number from a financing perspective that's not going to change for our 10-year financial forecasting like I was going into. But when you're in an environment like right now, sometimes it doesn't make sense. So we assume this mortgage lower than 3%, and it's going to be in effect until 2029. So having that is extremely important. If we look at some of the metrics of this fund specifically, it kind of shows how well we've been managing it, because our average mortgage rate is just over 3%. I think it's 3.06% right now, which is on a $1 billion portfolio. But more importantly, our term to maturity, so the average term to maturity on our mortgages right now is sitting just over 7 years. So when we're looking at this current interest rate environment, it's not really affecting us because we came at it from a conservative point of view, and we've been prudently managing this portfolio. Now, roughly 70-ish% of our portfolio is in that portion of it, being the underperforming or undervalued existing assets. About 20 to 25% of what we're doing is in new builds. So this was, let's call it 2019 or newer. And the reason why I say that here specifically is because when you go past 2019, rent controls are not in place anymore in Ontario. Not a lot of people know that. It gives us a little bit more flexibility with the rental income that's coming in. Plus, there's a lot less capital expenditures for the fund in terms of retrofitting new units when people are moving in, but also expenses like roofs and common areas and garages and that type of stuff. You don't have to worry about that as much. Plus, they tend to be cash flowing at already a high rate. So that's one of the reasons why we like those, because it really helps us to pay that monthly distribution that we're giving to our investors. So if you take those two into consideration, one's good more from an appreciation side, and one side is a little bit more from a cash flow side. Now, the final piece that we do, and this is never, I mean, the mandate of the fund is 15% as a whole, but typically we're looking to keep it under that, is new development. So actually building purpose-built rentals. Now, the reason why you want to do these, or why you want to have a portion of these within your portfolio, is because of the cost. It costs less to develop a unit than it does to buy a unit. That's just the reality of it. And when you can do that, and you're building fairly large buildings at this point, obviously, because we're doing this from an institutional level, Actually, the one project we have within the fund right now is in Ottawa. We're building 1,000 different units, 3 different towers over there. So what that's going to do is it usually gives you about a 20% bump from the value compared to what you paid for it. So when those are completed and you move it into the fund, you see a big increase in the unit price, essentially almost right away because of the cost versus what these are actually worth. So by having these 3 different segments within the fund, we're taking advantage of all the different areas. So different market conditions affect different sides of it, and we're making sure that we give our investors the returns they're looking for. With this fund specifically, there is a $25,000 minimum, so you don't have to come up with hundreds of thousands of dollars for a down payment. Don't have to secure any type of mortgages with getting into something like this. And if we look at what we're doing within it, we are targeting an 8 to 12% net annual return for our investors. So that's what they should put in their pocket at the end of the day. If you look at the last 3 years trailing, I think we're a little over 11.9%. Again, always better to under promise than over deliver than the other way around. So that's what that looks like in terms of an investment for our investors with it.
Wow, lots to unpack there. Yeah, lots to unpack. Like the one thing that's kind of cool is you're covering it from several different angles, which is kind of neat, right? And you're dealing with different types of markets and different types of strategies in regards to within the company in itself, being development, existing portfolio, increase in valuations of the multifamily deal, and even just do construction. Lots of great stuff there. One of the pieces I wanted to ask you, and it's an interesting one because I don't think it's really talked very well in our industry, is the process of due diligence. And when you're dealing with a company the size of Equiton, I'm just going to guess it's kind of an important thing that you guys are probably doing before you're investing millions and millions of dollars. Maybe you can just highlight, what is the process of due diligence important? What is Equiton kind of doing from a due diligence perspective that we can all learn to be better at?
I mean, it's really just making sure that you know what you're looking for and making sure that you're looking for opportunities that some other people might not see as well. I feel like for us, that's one of the major things. But like you have to take into consideration more than just the building itself too. Like you have to do market surveying, you have to see what other buildings are doing in the area in terms of, again, that's creating that opportunity from the gap to market. If we weren't looking at what other buildings are doing in the area, we would have no idea and what they're charging versus what we could be charging over time. Not to mention if they're doing other things in the neighborhood, like again, putting up commercial properties close, like is there transit that's really close? Are there parks really close? Like people take these into consideration when they're looking for a place to live. So making sure that you're going to have low vacancy rates and that you can charge maybe a little bit more than some of the competing buildings, that might be something to take into consideration. Then you look at things like capex, which is huge. Like you can't overpay or you're going to be chasing pennies the whole time. So you need to make sure that you're getting engineers in there, that you're making sure that there's no foundational issues. You need to make sure you know when the last time they updated the roof was, when the last time they did those parking garages is, because those are some major expenses with the building. What's the plumbing look like? What's the electrical look like? What's the heating look like? Like there's so many different things to take into consideration. But really for advice that I would give to others is don't overlook things and make sure that you have some type of template that you're going off of for every single building that you're buying and making sure
Yeah.
that you have a specific process that you're going through so that you don't miss anything. And or even things looking for opportunities, like how big are the layouts? If you're buying a building that was built back in the 70s, they have massive layouts. That's typically not necessarily something that you need today, and people aren't necessarily looking for it. So could you turn a 1 bedroom into a 2 bedroom or 2 bedroom into a 3 bedroom? That's going to command a lot more rent than what's currently in it. Because as I said, the valuations, these go right to the bottom line. If you're charging, I don't know, $1,000 for a 1 bedroom, and I'm just using arbitrary numbers to paint a picture, but got a 2 bedroom and you can charge 1,500. Well, you just increase the profitability of one unit by 33% overnight, right? So those are some things that maybe don't necessarily cost a ton of money, but over time, the ROI, the return on your investment that you're getting on these, just is astronomical, and it's a lot more than what some people think it would be over time.
Yeah, I agree. And the one thing that I like about your strategy, which is the same strategy that I do, is the multifamily space. Is even in during times that are challenged, like we're seeing today. He's got high interest rates. Well, we'll talk about landlord tenancy branch in Ontario in a second. That's always another fun topic. But it's there's always opportunities. There's lots of money that can be made. And so for people that are listening to this, you're listening to a ton of experience from Kyle, like lots of knowledge. But for those that are in the residential space, it is crucial that you understand that it is a significantly different strategy than multifamily. You need to learn it differently. And I always joke around is you need to take your residential investing hat. So kind of a lot of the things you learned in residential investing, take that hat, go throw it in the garbage and put on your multifamily hat because that's what you need to be in how you need to implement this because it is quite different, right? Right.
That's funny because just adding to that, and I know some of the guys here are going to make fun of me for this because they hear me say it on the phone. They're always like, "How do you put that into a conversation?" But when I'm actually comparing and people are comparing that, I say I want to go to Men in Black. You ever watch the movie Men in Black? They have the memory eraser. Well, I'm going to erase your memory right here. We're going to take this from a blank slate, and I'm going to educate you on what this space looks like rather than that space. So I know if some of the guys here see this on video later, I'm gonna get razzed for that. But it's the reality of it. Like you said, it's a completely different frame of mind. You got to come at it different. So forget what you know and start learning the new side of it if that's what you're looking to get into.
Awesome. Very good. And just so you know, Kyle and Mike Pondy are not necessarily recommending Men in Black to watch, and we're not necessarily approving it or not approving it. I'm only joking. It's actually a pretty fun movie. So real cool. So the one thing I want to ask you, and I think this is such a crazy topic right now, which is Ontario just in general. There's lots of crazy stuff going on there. And I know for a lot of people, they're struggling, and I'm sure you're probably hearing some of this stuff too, Kyle, like I am. I'm getting calls, like, I swear on the daily, and it's just about help. They're struggling with landlord tenancy branches, and for those that are not necessarily aware, we got tenants in there that are not necessarily paying, haven't been paying for like 8, 9 months because they can't get in front of the tenancy board or get in front of the courts to get these guys evicted. So you've got tenants living there for free, and it's an ugly mess. And then to add insult to injury, you got these costs of interest rates obviously high. Um, yeah, it's causing a lot of issues. And so with that being said, I'm also seeing people leaving the business because of some of the challenges that people have faced. We had people losing tens of thousands, if not hundreds of thousands of dollars, or even just to evict some of these tenants. For those that are not aware, of something called cash for keys, which they're literally paying tenants to leave, to get out of their building, and it's cheaper to do that. And some of the numbers are just absurd, to say it lightly. And with some of the turbulence and challenges that are happening in Ontario, and I know you guys are heavily invested there, how are you guys mitigating and some of the issues in your guys' existing business? And how are you guys looking at this as a potential opportunity at Equiton? Do you guys see this as an opportunity, or is this something you guys are trying to just mitigate yourselves? So maybe you can elaborate. I know it's a lot to unpack and multitude of different questions all in one, but maybe you could just highlight some of the things that you guys are doing.
Yeah, for sure. I mean, like number one, when you're buying assets as large as we are, you have to allocate some of the money to dead money. Like that's just the reality of it. Especially in Ontario, with as hard as it is sometimes to get people out who aren't paying rent. Now, obviously, with that being said, you got to be sensitive to people's situations as well. What we noticed is just being human about it and reasoning with people on certain things. A lot of times you can resolve this by getting people on payment plans, by creating some type of expectation moving into the future. And if they see that you care and that you're willing to help them as much as possible, then it kind of mitigates that conflict that's happening. So that's one side of it, and we're always going to take that route first, and we're always going to give the tenants the benefit of the doubt. With that being said, obviously there's going to be some situations where it's unavoidable. The first thing I need to say on this is make sure that you're doing things in a timely fashion,
Yeah,
because
agreed.
then you could be getting to that 8, 9, 10 months without collecting rent for that individual unit. When people do miss a payment, or they're not responding, or they're not willing to work with you, make sure that you're giving them notices as soon as you can, and creating expectations moving forward, because that's going to help you when you start to get further in the process, and actually being able to get people out who are delinquencies, with that being said. Again, just working with people and doing things in a timely fashion is the most you can do from the front end. But with that being said, I mean, right now you're seeing a lot of competition in the market from a rental perspective because of affordability. It's pushing a lot more people into long-term rental situations. I believe it was BNN. They did a study actually, and the results came back. Actually, I was surprising that more than 42% of Ontarians are saying that they'd probably be in a rental situation for their whole life, and that they actually don't mind that, because it gives them a little bit more flexibility with their living situations. And that's just the reality of affordability and housing prices. But what that does is it creates strain on the rental market. So if you look at the vacancy rate at this point, it's extremely low. We, in our portfolio, it's around 1% vacancy, which is the lowest that it's been since we opened the fund. And in Ontario or Canada as a whole, these numbers are fairly close. I believe it's more just under 2% for the country as a whole. With that being said, that just goes to show what's happening. Now, another thing that I'm noticing specifically on this topic is that people don't want to get evicted. And the reason why is because if you are living, like in Ontario, we have rent control, right? So if you're in a specific unit and it's, let's call it $1,500 a month, but the national average is closer to $2,300 a month. If you can't pay and you get evicted and you've been living in it for a little while, your cost of living is going to go up immensely. Yeah. We're talking 1.5 to twofold in some cases for these tenants. So being reasonable and working with them as much as possible to get them on a plan to try and see what we can do moving forward. A lot of people are open to that, and that's really the route that we're taking, because typically it's in their best interest to be doing that as well. So with those two sides, there's always going to be a little bit of a pain on that. So for investors, I mean, that's one of the advantages of working with Equiton, is you don't have to deal with that yourself. You got a full team on doing it. As we're having regular turnover, we're making sure we're doing proper tenant vetting, which is extremely important as newer tenants are moving in, just to make sure of that. I mean, if, again, you don't go too much into it, but if you have, let's say, a 2-income household rather than a 1-income household, that'll help with some of the risks that are involved with the tenant delinquencies, et cetera, et cetera. So there's a few different ways that you can mitigate the risk, and there's an opportunity based on the current market conditions for rents moving forward because of that.
Yeah. And I think you've built that right into your plan. That was the one thing I've always, you know, Kyle's been great supporting our savvy investor community and just being a very open book and sharing some of kind of the back ends of Equiton. And the one thing that really stuck out to me is your guys' initial plan from the very beginning is, you know, you're looking at an asset and you see the opportunity, but you're referencing a turnover of that building in roughly 10 years. Right. And so for a lot of investors out there, you know, they're looking at like 1 year turnover, 2 year turnover. They're trying to get that done. And in times, in a situation where you are got rent controls, it's tough to do that in that type of time frame. And so for you guys are doing this over a 10-year time frame, correct?
Correct. I mean, we take a conservative approach to everything we do here. If you can be conservative with your numbers, then if regular things happen, then everybody's happy. Under promise, over deliver. Be conservative always with your predictions and financial forecasting, and you're always going to end up on top. And it's been proven time and time again within our portfolio. 2022 was a really good banner year for us. I mean, when you look at housing prices going stagnant or even moving in a downward trajectory in some areas because of how aggressive the Bank of Canada was with monetary policy, raising interest rates the fastest that they have since the early 80s, we were still able to give our investors almost a 14% return in that year. So it's being conservative, it's knowing what to look for. And that's going to work out for you in the long term, in my mind.
I agree 100%. And that's the beautiful part about multifamily. It can be a great strategy when you're knowing what the hell you're looking for and what you're doing. To be honest, it can be very painful if you don't. And I think that's crucial. If it's a strategy that you guys are trying to facilitate or trying to implement in your business, just take the time to educate yourself first and foremost. Or if you like the strategy, it's even kind of bringing on somebody like Equiton to kind of say, hey, you know what, I don't want to do all that work. It sounds like a lot, 10 years. Maybe it's just better to kind of facilitate it this way. So and I kind of agree with you more. Like this whole affordability thing is becoming a hot potato for everybody. Governments are talking about this all the time. We don't have enough inventory, we can't build, but at the same time, costs are just through the roof. And it's during times like challenges like we're seeing today. Like, we hear all this negativity, a cost of inflation, we hear costs of mortgages going up. But this is actually a positive in the multifamily space. It's a really good space to be in because of the opportunities when you're acquiring right. And I'm assuming you guys are kind of feeling the same way, Kyle, and maybe just highlight, what are you guys doing? Do you guys see this as an opportunity? And are you guys taking advantage of this today?
I feel like multifamily is one of those asset classes that is like a proven hedge against inflation. It's one of those asset classes that, as long as you know what you're doing, you're not overpaying. And again, being conservative by nature, it should churn out the same type of numbers year in and year out. I mean, when you're comparing it to something like single family, let's call it, I say that there's a lot of emotional volatility in single family housing. And the reason why is because who you're competing with is people who want their kids to grow up in a certain area, or they want to be close to their aging parents, or they need to be closer to where they work from a commute perspective. So people tend to get emotional, and for obvious reasons, on these topics, which creates a little bit more of a wave in the market, I want to say, just because when things are going really well and housing prices are moving in an upward trajectory, we tend to have a supply demand issue where there's way more demand than there's supply, which moves people into bidding wars. And if I'm going to pay 100,000 more than you, Michael, for a house, then I'm the one who gets it. But that sets certain precedent in that area that now when others go to sell, they're going to be like, well, that person got 100 more than their asking price, so I'm just going to list mine there. And it moves in an upward trajectory. But then when things happen the opposite way, they tend to come down a little bit, which is what we're seeing with monetary policy and interest rates moving the direction they have been. So there's a little bit more of a wave when you're doing that. When you look at multifamily, because of the way they're valued, which again, the net operating income, if you're on top of capital expenditures, you're doing proper ESG initiatives, which is not only good for the environment, but it also lowers costs in terms of more efficient lighting, more efficient plumbing, low flow toilets, et cetera, and you're able to increase in small increments year over year, then it kind of chugs along, but it's always a little bit behind the curve. So housing prices go way up, multifamily is not good, it'll go up, but not quite as much. But then when these dip, it's right where this was supposed to be. So I noticed that it's a little bit more steady eddy in a sense that it's a little bit more predictable in terms of the way that it flows. With that being said, a lot of it goes into, as I mentioned before, that due diligence process and making sure that you're not overpaying in the beginning. Now, I would never expect this to give you a 40-50% return in 1 year, but it can, for us at least, churn out that 8 to 12% every single year in and year out type of numbers.
Yeah. Yeah. See, guys, there are opportunities in challenging markets, right? So it's interesting. So are you guys active right now? Are you guys buying stuff at this point?
We're starting to get more and more active. We were taking a little bit of a sideline approach during 2023. We didn't have as much acquisitions as we had in years past, but really that's just because, again, that curve. When interest rates start skyrocketing, prices don't stabilize to where they necessarily should be. And we have to take that extra cost from a financing perspective into it. So some of the ways we were able to buy was, like I was saying, with some of the ways we were creative about it. But now people are coming back to the table with deals that we were looking at last year. We usually end up looking at 30, 40 buildings before we even buy one. Again, that's being conservative in nature and running it and making sure that your offers make sense and what could essentially drive a profit moving into the future. So we are seeing the market start to open back up, and we think 2024 is going to be a bigger year than 2023 in terms of purchasing.
I agree. And I think that's the thing is, I for me, I see opportunities. I really, really do. And so it's just being open-eyed and looking for that and building out your team extensively, especially in this space. But I think Kyle's been drilling this into our brains is it's got to be bought well and it's got to be bought right with a very clear strategy. And if you do that, you're mitigating a lot of the risks that come along with this business. And this is the one thing about I love about this multifamily space is its numbers, all numbers, and you can start to crunch a lot of these things to make it sure it makes sense and you have a good plan, right? So
You hit it right on with that. It's a lot more numbers based. It's a lot more science than art sometimes. Whereas, I mean, there's always going to be that art side of it where you have to take that into consideration. But being able to run the numbers and knowing what you're looking at on paper is extremely important.
yeah, love that. Love that. um Kind of getting to the top of the hour here. So what I always like, and I ask this question of all of our guests, is final kind of words of wisdom. You've been in this space for a long time. Equiton's done incredible, true, and honestly, guys, amazing company. I think you guys are actually got a new property purchase. You guys have just done roughly $32 million one. It's not a small little building. Um, Maybe highlight a little bit about the project first, and then maybe some words of wisdom for our community about people that are maybe looking to get into multifamily or just looking at multifamily as an investment strategy.
So the new purchase that we're doing here is the second side of the business. So we are developer as well. So we're actually developing a condo East End Toronto, Broadview, and Danforth for anybody who's in the area. And this is going to be about 355 individual residential units on that side. I think that it's a good business to start getting into now. I know that condo prices and sales were down for a while, but if you're actually looking year over year from 2022 to 2023, they're actually up 41%. And based off number one, let's say population growth, immigration coming in. I'm not going to go too much in the numbers because I'm sure everybody's heard about this.
Yeah.
But we have challenges from a building standpoint as well because of red tape. So how long these are taking to actually be able to build, and Toronto specifically, just because we're in the market over here, is on an island without being on an island. If you look below us, we got the lake. Above us, we have the protected green belt. The urban settlement is everything in between. It's pretty much built up at this point. So we're starting to go vertical rather than horizontal at this point because there's no land left to do it. So if people want to live in and around the GTA or be a part of the greater Toronto area, let's call it, that's just a reality. And what people are going to have to get used to moving forward is getting involved in something more vertical rather than horizontal. Now, I think it's a unique situation from a development standpoint right now, because if you're not going to pre-sales on condos for the next, let's call it year to 2 years down the line, that's prime opportunity with what we're looking at from, again, a monetary policy standpoint. I think the money's there. I think the money's on the sideline waiting to get involved in these type of projects and to be able to buy these type of units in prime time areas like that. But until the federal government, I mean, they're dovish right now on raising, but they're still pretty stern on holding the interest rates where they are. Some people are saying as early as June. Me personally, I'm a little bit more conservative. Again, that's just the way I am. I'm thinking more like the end of the year when they'll start moving interest rates in the other direction. I don't think it'll ever be what we saw during the pandemic, because 0% interest just doesn't make sense. But if they could go, let's say, half of what they are right now, that's still a prime time position, and people are going to start buying again. So if you can get involved in development projects that, like what Equiton's doing, you're not buying a condo unit. You're not banking on appreciation once it's built. We're doing it now, and we're saying in 2-3 years from now, we're actually going to go to pre-sales on these things. So you'll bank off the appreciated value from what we see today till then, which things should be in a different situation what they are right now. Now, development projects are kind of the let's call it the sexiest investment from a return standpoint, from a passive point of view. And the reason why I say that is because when we do these type of projects, we're aiming at no less than 20% average annual returns during the course of the project. Now, development's a little bit different, and it takes on a little bit of a different risk profile than something like a multifamily fund. The way these work is you put your money out today, you see no type of return. 5 years down the line, people take occupancy, you get all of your return in the form of one lump sum payment. But you should double your money. So if you invest 100K today in something like that, in 5 years from now, we should be cutting you a check for $200,000. That's, from a return standpoint, it's extremely attractive. And we typically always have one development on the go. We have 5 different ones that we're in the process of doing at this point. As I mentioned, we have 1.5 billion in the development space at this point. But that's something that's really exciting, and something that we're looking into the future, because it has more of a forward looking point of view than what's happening necessarily today in the market.
Love it. Love it. If people wanted to learn more about Equiton and what you guys are up to, what's the best place to kind of?
I would say go on the Savvy Investor website. You guys have a link directly to us. If you fill out the form there, what it's going to do is it's going to come directly to me.
Yeah.
So I manage that personally. Me and my assistant, his name's Madison. One of us will reach out to you and
Cool.
we'll get you on the phone. I'm very educational by nature, as you can tell with these.
Yeah.
All I want to do is just kind of let people know what's available to them, educate them. And then if it's something that makes sense, then you come to that conclusion on your own, then great. So I would suggest to do that. Also, we're going to be running another, after we post this on the Savvy Investor website, I believe we're going to be doing a following ad just based on that specific development I was telling you about. So you can see the particulars of where it is, the financial forecasting that go into it, the neighborhood, all of that type of stuff. So feel free to keep an eye on the Savvy Investor Network there, because we're going to keep flowing information through there. Rather than come to our website, just stick to Savvy's, because you'll deal with me directly rather than one of the other 28 reps who work here. As I mentioned, I'm an associate vice president, so I have my own team of 8. So typically I work within that, but you can come directly to me from there.
Love that. Kyle's been just a wealth of knowledge and support for our community, to be very honest. And he, very, very honored to have the team at Equiton, part of our trusted partner program. And what we'll do is I'll add the link into the show notes there. Reach out, like I said, Kyle, that's one thing I like about Kyle. He's more than happy to ask questions. It's not this big hard-nosed sales approach to this thing. It's either a fit or if it's not. But at least it gives you some other options to explore in your investment portfolio and your business in general. So, Kyle, thank you, sir. I really appreciate all your knowledge and wisdom and sharing with our community, and definitely would love to bring you back onto the show here in the very near future.
Of course, I love doing these things. I love, again, educating people on the space. Not a lot of people know about these type of investments, the way they work, and when they do, they're like, I really wish I knew about this earlier. So being able to help people save for the future and help see what it does for them in their retirement, or helping their kids for the future, whatever it is, that's what I'm all about. So anytime you want me on here, just let me know, and I'll make sure I make time for it. Okay.
Awesome. Thanks again, Kyle. Appreciate it. The views and advice expressed on this podcast episode are solely those of the individuals participating and do not necessarily reflect the opinions or beliefs of the podcast host, its producers, or affiliated parties. All content shared is for entertainment purposes only and should not be considered as professional, financial, legal, or investment advice. Listeners and viewers are strongly encouraged to conduct their own research and consult with qualified professionals such as financial advisors, lawyers, and accountants before making any financial decisions or investments based on the information provided in this podcast or any related content. The podcast host and producers disclaim any responsibility for any actions taken by listeners as a result of information presented in this episode. Viewer and listener discretion is advised.